Welcome back. We're discussing the ongoing woes of Wall Street and how America's financial crisis is affecting the rest of the world. Joining me from New York is John D'Agostino, an oil and commodities expert with hands-on experience in the Middle East and Asia. And here in the studio, I'm joined by Dean Baker, co-director of economic and policy research, a think tank based in Washington, D.C. And I have an email, actually, Dean Baker, if I could put this to you. It comes from Leonard Bertram in Germany. And it says, the current crisis is just the tip of the iceberg. There is no counter value to all the money which is in circulation. And while Barack Obama does not grasp the depth of the problem, John McCain doesn't care because he is one of the beneficiaries of the system. I wonder, when you look at this has been doing to the two parties, what kind of impact do you think it's having politically?
Well, it's really been kind of an earthquake, coming just 5 weeks before our election, and it's really just knocked both candidates off their balance, and probably for the most part it's been to Senator Obama's favor, because the way this plays out, generally when the economy's bad, it works against the party in power as a general rule, so that hurts Senator McCain. Also, Senator Obama is better versed on the economy. I mean, Senator McCain, in an offhand moment some time back, said, I really don't know much about economics. He's since tried to say he was kidding or whatever, but I think that does reflect his general attitude that he's not interested. It's not his main area. He likes to focus on foreign policy. So we're getting an election that's focused primarily on economics, and certainly in our congressional elections, this has been a bombshell. And the vote that they had on Monday was one of the most contentious votes that they've ever taken.
And John D'Agostino, we've got an email that came in from Vancouver in Canada. Our viewer called Mark wrote in saying, there is something wrong with the whole system. Pumping $700 billion is just a patchwork solution. We need moral and regulatory reform. There is too much government. If Wall Street is incompetent to manage risk, let them all fail. The system will clear itself out. Printing money and overtaxed people is not the solution to the crisis. Of course, there's a lot of people questioning this, and I wonder, when it comes to how regulations might change following this whole situation settling down, how do you expect things to change at a regulatory level?
Sure. Let me just quickly address his last point, because I think it's the most salient and the one that people are really driving at. Why don't we let the market fail? Let's just let it fail. I think there's a misunderstanding between letting certain participants on the market fail and letting the market itself fail. That's what I did when I was at the NYMEX. I built markets. We created markets. And there's a wonderful thing about liquidity and about liquid markets is they're extraordinarily difficult to build, but once you have them, they're extraordinarily difficult to destroy. Liquidity breeds liquidity. When something happens, when there's some shift that causes that liquidity to break, it becomes just as difficult to rebuild them. So just to be clear, what we're talking about is not let a few people fail. A few people have failed. We're letting people fail. We're talking about the absolute loss of all traction and liquidity in this market. So that's why we shouldn't let them all fail. Now, with regards to the regulatory environment, I fully agree. I mean, look, this is like a trauma patient coming into the ER. I mean, first thing you do is stabilize, and that's really what this plan does. Then you get them into surgery or treat them with medicine, and then you go into rehabilitation. So we haven't reached those phases yet. We're going to have to rethink how we view global markets, integration with global markets. We're going to rethink how we view self-regulatory organizations. There's going to be a lot of work that needs to be done. But again, because this particular market is so crucial, that's why you're seeing this plan being rushed in place when you didn't see it when the energy market was faltering and so on and so forth.
Right. Dr. Baker, this email that came in from Julia in Wisconsin in the USA is interesting. It says, welcome to reality for the 20-something crowd. It means no more easy credit, and maybe they will see the sacrifices their grandparents had to make. Of course, one of the key issues is what happens to all the retirement plans and all the hopes people had built up for some kind of return on their investment.
Well, the retirement plans will be fine. Again, this movement in the market day to day is not anything to worry about. We actually had a much sharper fall in the stock market, of course, back in 2000 to 2002. That was when you really did see people's retirement plans knocked out. The bigger issue for most people is their home equity. That is the root cause of the problem. Again, this is one of the things that's been upsetting me about the way Secretary Paulson, Chairman Bernanke have talked about it. We had a housing bubble that they let grow. They denied it existed. They fostered it. It's collapsed, and the financial chaos is a side effect of that. The big problem for most people is that they've lost most of their life savings, because that's mostly in their home. Most people have very little money in the market to begin with, so for most people that's a sideshow. What they really do have, or they did have, was $100,000, $200,000 in equity for millions of people. That has just disappeared.
Now, what does that do to the movement of labor force and workforce in the country, the mobility of people? What kind of impact do you think that will have?
It's absolutely disastrous. Again, this is why it's so frustrating to have, we have Secretary Bernanke jumping up and down because of Wall Street, and the tens of millions of people that, they're underwater in their homes, they're losing their homes. He has nothing to say about that. That's irrelevant to him. And again, it's just what do you want to call a crisis? His friends at Goldman Sachs, it's a crisis. But for most of the country, the crisis is what's happened to their home. There's no good answer to it. I mean, what he should have done was prevent the bubble from growing as he did, but he looked the other way. It was an incredible act of negligence.
John D'Agostino, how do you see this affecting the average person in the US? I mean, how do you think they will actually feel the pinch in their wallets?
Well, they'll feel it in their ability to not live the lifestyle that they've been living. They'll feel it in the ability not to get credit in the form of credit card lines, auto loans, again, mortgages. I did my own little experiment recently. I'm not sure where this data is coming from that you can get a 6% 30-year, but I have pretty good credit, and just for giggles, really, I gave up a call last week, so I hear everyone talking about how easy it is to get a mortgage, and I requested the originator, which happens to be my bank, for a mortgage that was less than the entire amount of cash I had in the bank. To give you, it was a pretty safe bet, and it came back at about 9.5%. And when I queried them on it, they kind of called me up and said, "Look, I know this is insulting, but we don't want to do mortgages anymore. We don't care what your credit's like, how small the loan is. We don't want to do these things." So the average person, I think, will feel it in that way. And just a quick note on the stock market's impact on the average person. Pension funds, even though they generally have a smaller percentage in the equity markets, rely on that percentage to contribute to a great degree of the alpha that they need to meet their liabilities over time. So I would argue a 20 or 40% correction, sustained correction. We're not talking about a unique event like 9/11 that we're able to recover from quickly, an idiosyncratic event. I'm talking about a prolonged recessionary and economic downturn where we've got a 20, 40% decline in equity prices. I would argue, and I work with pension funds, that would severely limit their ability to meet long-term pension liabilities.
Now, what do you think this will do to the dollar, Dr. Baker?
Well, I hope it lowers it. I mean, the dollar has been overvalued for a long period of time. That's the root cause of a lot of our problems. That's why we have a large budget deficit. That's why we had very low savings. That's why we had this bubble economy. We had an overvalued dollar. It's amazing to me that you have people elsewhere in the world that were willing to put their money in U.S. dollars, getting incredibly low interest rates. Today, they're getting almost zero, and some days we had negative. And a currency that's so weak. We have a trade deficit of $700 billion. If I didn't live in the United States, I wouldn't have a penny in this country. I mean, it's really bizarre, that behavior. Let me just mention, by the way, my number on 6%, that came from the Mortgage Bankers Association. I don't think they're making up their numbers, so I think that's a reliable source on what the mortgage rates are.
Do you think on this issue of the dollar that other economies, other countries, I should say, that be looking at the relationship with the U.S. will start to distance themselves?
Well, I think they have to look more realistically. It's been amazing to me that people always say, well, they put their money in dollars because it's safe. And you go, well, what do you mean by safe? The dollar fell by about 70% against the euro between 2002 and 2008. So usually I think of safe as something that will hold its value. The dollar wasn't holding its value. Now, if you talk about, is the United States going to go out of existence? Well, no, but neither is England, neither is France, neither is Germany. So in the sense of, what's a secure store of value for your money, the dollar clearly is not, as long as we have these sorts of huge trade deficits, and the only way you correct the trade deficits is a lower dollar.
John D'Agostino, with less than a minute to go, let me get your perspective on the dollar, where it goes, and when you think we will stop talking about this story.
Well, I think there's tremendous downward pressure on the dollar because of this. There's no doubt about it. I think if people move out, if countries move out of the dollar as a safe haven, they move into commodities. So I think you can expect another prolonging of the bull run in commodities. This will add to that. When will we stop talking about this? Probably when the next catastrophe happens. That seems to be how things are working now. So this is the seminal moment in, I think, most of our lives relative to this economy. So I don't think we'll ever stop talking about this, because when we finally settle down and come to an agreement, even grudgingly agreement, then we're going to talk about who's to blame. And that conversation people will enjoy even more, and it'll go on for years to come.
Right. John D'Agostino in New York, thank you very much. Dean Baker, thank you very much for joining us here in DC.
Thanks for having me on.
Thank you, sir.
Thank you.
And thank you for being with us. On the next show, the story of a small town in New Jersey which united behind a Muslim community leader after it felt the imam was unfairly targeted by the US authorities. An interesting story. Hope you'll join us for that. And you can send your thoughts to any ideas you have to riz@aljazeera.net. And you can also follow us on Twitter. And as always, we'll include the best comments on the show. From me and the team, we'll see you next time.